Hey employers, I'm Mike Krupa, and today I want to talk about how you can evaluate your different funding arrangements that are available to you for your health insurance plan. And I primarily see 5 different types. First being a private employer organization, or a PEO. These are generally a better fit for employers that have roughly 10 to call it 75 employees. For an employer who's looking for a little bit more infrastructure, they don't have a big robust team, might even be looking for some more health insurance options, a PEO might be something that you want to consider. Just note that it's a co-employment relationship, so that is probably one of the bigger considerations to take. Next is the most common that I'm sure everybody's heard about, which is fully insuring your health insurance plan. And I'd say most employers that have under 150 employees enrolled on their health insurance plan are likely fully insured. There's definitely some exceptions to that, but a fully insured employer is somebody who is a little bit risk adverse. They want a very predictable cash flow every single month. That's the primary reasons an employer would be in a fully insured arrangement. Kind of the next step is a level funded arrangement. And this is a good step towards self-funding. I typically see level funded employers ranging from around 25 employees to about 150 employees on the health insurance plan. And kind of 2 different ways to do this. You have your traditional health insurance carriers like Blue Cross, United, Cigna, Aetna that have their own level funded platforms. And then you have what I call non-traditional options, which allows you to bake in some cost containment programs. And for employers that are looking for a little bit more data, kind of want to dip their toe into the self-funded waters and start to establish some control with cost containment, level funding could be a very, very good solution. Next up is a self-funded employer, and I generally see employers starting to consider this when they have about 150 employees enrolled on their health insurance plan. Now, I have an employer that has 30 employees on their health plan is self-funded, so there's definitely exceptions to that rule. Being risk tolerant is probably one of the biggest things that drives employers being self-funded, because you got to deal with that variable cash flow. But for employers who want even more data, more transparency, and kind of full control over the different partners that are within your health insurance plan, self-funding is definitely the way to go. And similar to level funded, there are your traditional self-funded carriers and then the non-traditional ones. And I would point you probably more in the direction of the non-traditional ones, especially if you're trying to contain some costs. And then the last option is been gaining steam in the marketplace. It's called ICHRA. And this is basically where you give your employees a stipend to purchase an exchange policy. So they'll actually use that stipend, go out to the individual exchange market where there is a plethora of options available to them. And they'll purchase their own plan. These are good for employers that want out of the fiduciary game. This is good for employers that just want out of the benefits game, period, are sick and tired of having to come up with strategies every single year. I find good candidates are ones that have very high costs and pretty bad plan designs. And again, I generally would see this in the sub 150 employees. Again, there's definitely exceptions to that rule. But generally in that type of range, but probably primarily like you want out of benefits, you should definitely, at least look at considering some sort of ICHRA plan. So those are the 5 options I'm going to talk about today. I hope you found this information helpful. If you want to know if you're a good candidate for any one of those options, feel free to reach out to me directly. Thanks.